Welcome to the Benefits Executive Roundtable, hosted by Dorothy Cociu, President of Advanced Benefit Consulting. Dorothy is a nationally recognized benefits and compliance consultant and group health broker. Here, you will watch and listen to industry experts who will break down the latest trends in employee benefits, healthcare reform, state and federal legislative and regulatory activities, all designed to empower executive decisions. We are proud to bring to you all new for Season 6 video podcasts. We hope that you enjoy your new video podcast format, and please forgive any audio or video imperfections. Thank you for viewing and listening.
Welcome to the Benefits Executive Roundtable. I'm your host, Dorothy Cociu, President of Advanced Benefit Consulting, and I want to welcome my very special guest today, Ann Kelly, President of Kelly & Kelly Insurance Services. Thanks for joining me today, Ann.
Thank you, Dorothy, and I am delighted to be a guest today, and hopefully by the time we finish today's podcast, people are more enlightened and feel better about their knowledge level on income taxes versus tax write-offs through payroll.
Well, thank you very much. Matter of full disclosure, Ann's a very dear friend of mine, like family, really. We've spent many family holidays and so forth together over the years. You joined me on my podcast last year as part of a panel on preparing for open enrollment, but this year you're on your own. How does that? Focus is all on you. So I just want to throw that out there. But you wrote an article recently, which is why I wanted to have you on the podcast, and it was published in an industry publication. And it was on tax write-offs on cafeteria plans versus income tax returns, regular write-offs on income tax returns for 2024. And I want to let our audience know that before Ann was in the health and benefits industry, she was actually an accountant way back when in Ireland, correct?
That's correct, Dorothy. I was a cost accountant in Ireland. And I think now they call that maintenance accounting, but it's basically forecasting budgets.
You have that knack for understanding things like numbers and tax returns and things like that. I always give you a hard time because, as you know, tax returns are not my thing at all. I pretty much cringe at them. So I'm going to leave that to the people like you that really actually enjoy these kinds of things because I don't. So thank you for enlightening us today on some of this stuff. Just for some background, in case some of our audience is not as familiar, tell us what a cafeteria plan is in general.
So a cafeteria plan, you'll hear it called different names. Officially, it was Section 125 of the IRS regulations, and that came about in 1978 in an attempt to make benefits more affordable. So there are fantastic advantages to the plan, and the plan can be very simple or it can be very complex depending on how much an employer wants to build that out.
Okay, well, let's talk about the key features of a cafeteria plan. Obviously, as you stated, they allow for pre-tax contributions, but tell us about that.
So a base plan that every employer should have, if you have a benefits program, is what they call premium conversion. You'll hear some people call it a POP plan, premium only plan, and you'll hear others refer to it as a pre-tax program. And when I started working in the United States, one of my first jobs was working for a third-party administrator administrating cafeteria plans. And it took me a few weeks to realize that all these different names were actually talking about the same program.
We love doing that in our industry, don't we? Making things a lot more complicated.
All the acronyms. But when you're talking about a cafeteria plan, the base level is premium conversion. And what that allows you to do, or your employees to do, is any qualified benefits that they're paying towards can be deducted free of all payroll taxes. So we'll talk in a while about qualified plans and what qualifies as a plan. But generally speaking, your core benefits, your medical, dental, vision would be qualified programs because they are, as a rule of thumb, reimbursing direct expense.
Right. Well, tell us about the importance to both employers and employees. There are actually two different types of advantages depending on what side of the coin you're on there.
And this is something a lot of insurance agents miss because they're not tax advisors. But from an employer's perspective, the money that the employer is actually paying towards the benefits is a tax write-off for them against their corporate taxes. So if you're a C Corp, an S Corp, the majority of that can be written off, and just in the back of your head, say, as a rough calc, I'm saving 22% on my corporate taxes for the money as an employer that I'm paying towards the benefits. As most of you already know, with the cost of healthcare going up, particularly since the 90s, the majority of those costs are weighted on the employee contribution side, because employers generally are not paying towards dependents. And some employers are paying very low on the ancillary products like the dental, the vision. So the average group of employees is actually paying 70% of your overall benefit cost. And they are deducting that if you, provided you have a premium only plan, free of all payroll taxes. As a caveat, working as a TPA, you're supposed to notify them that that will reduce their Social Security benefits possibly, which is 1.45% of their taxes. That's a joke. We won't go into the why. Very minimal. I will take the 30% on my payroll tax any day versus what I might lose on Social Security on that 1.45% of my benefits write-off. So they're reducing their gross taxable payroll. Most employees, particularly in California, they're in a 30% payroll tax bracket when you count all your payroll taxes. So they're now saving 30% of their cost of benefits. As an employer, and this is definitely overlooked, I would say, by 95% of insurance agents, they're not tax advisors. As an employer, you're paying matching FICA tax on the money that your employees are paid. So if they're writing off 70% of the cost of the benefits against taxable payroll, you're not matching the FICA tax on that. So whatever they're writing off, you can guarantee it. You're saving 7.65% on the FICA match. For those employers that have high workers' comp mods, particularly roofing industries, construction industries, auto dealer industries, your workers' compensation is a percentage of gross taxable payroll. So as the employees are writing off 70% of the cost of benefits, that is reducing your gross taxable payroll. So whatever percent your workers' comp is on that, you're saving that as well as the FICA tax. Don't overlook it. That can be a substantial amount.
Yeah, absolutely. Well, there are a couple of different types of cafeteria plans. As you mentioned, a premium only plan. And then there are also optional flexible spending accounts, or FSAs, which a lot of us refer to because we love our acronyms. Can you tell us about what these are and what they offer?
Yeah. The flexible spending accounts, there's two. And you can have one or both available to your employees. And there's caveats and reasons that are advantages and disadvantages on why you might want to do that. So you want to look at your employee base. If you have a lot of young employees that have young families and they're paying daycare expenses, or you have older employees that are paying dependent expenses for an elderly adult that is on their tax returns as a dependent, and they're paying that daycare or full care expense for, that is also a tax write-off through the dependent care flexible spending account. Again, you're looking at that and saying, if I allow my employees to do that through payroll, most people in California, it's $1,000 plus a month on dependent care expense. There are limits on what you can write off, but those employees are saving 30% of tax on that on payroll. And for every employee doing it, you're saving the matching FICA tax and workers' comp again. So that's a win-win. The amount that an employee can write off through their payroll versus their income tax differs. So you're looking at which way can I write off more, depending on my married or single filing situation, and then what percent of tax am I saving on my payroll tax write-off versus the tax credit I would get on my income tax write-off. Generally speaking, the payroll tax write-off can be better. So when you're looking at that, the annual limit that they set on the dependent care is $3,050 if you're single, $5,000 through the payroll, and then it doubles if you're married on the income tax return. However, remember your second cap there on that is what's the tax credit on my income tax write-off? It usually ends up being 20% or less versus that 30% on every dollar through payroll. There's a use it or lose it rule on the second FSA account, which is on reimbursed medical. So you have to be more careful with that. And then the Obamacare Affordable Care Act regulations reduce that from a write-off that the employer set, which could be unlimited, to a maximum per year. And that varies every year again, depending on the year in question. So I think when Obamacare came out, they limited that to $2,500, which was a shame because most people were using that on an employee write-off for children with dental braces. So if you didn't have a dental brace full coverage, which most plans don't, or they're only paying 50% up to $1,000 or $2,000, they were able to write off the rest of that through their payroll flexible spending account. So the write-off on the medical side, which covers medical, dental, vision and hearing expenses, not cosmetic, is more limited than the write-off on the dependent care. So the dependent care is a sure winner. The unreimbursed medical, you want to take a look at that and see if it's really going to benefit your employees. And that depends on the level of coverage you're providing them on the medical and dental, if they really have enough tax write-off to make that worthwhile. You don't want them, everybody writing off $300 or $400 and you're saving nothing and they're saving nothing. You want it to be substantial.
Okay, so you mentioned part of the caps. You mentioned the dependent care accounts, but can you tell everyone what the current caps are right now on flexible spending accounts?
Yeah, so the healthcare FSA annual limit is $3,050. And the dependent care is $5,000, right? You have a use it or lose it rule, which means that at the end of the year, if you don't have enough claims going in, your dates of service you didn't have enough expenses or dates of service within that plan year, you stand to lose everything in the plan unless as an employer you put in that they can roll over a certain amount of unclaimed expenses into the next year.
So they can actually write that into the plan document?
Yeah, exactly. And that would be a good idea, by the way, because generally there's always somebody that either doesn't submit claims or overestimated their tax write-off through payroll. So it's nice to have a little carryover in your plan and a grace period in which you can claim those expenses too. Make sure they have a 90-day run out.
Okay. Thank you for that. So let's talk about something else that you mentioned in your article, health savings accounts. What is a health savings account?
There's two things you need to be aware of when you're talking a health savings. One is an insurance medical plan that is a qualified health savings plan. And we're going to go into that in a minute. And you're going to marry that with a bank account. There are banks that will do this for employer groups that each employee has that they can write off money tax-free and put it in that bank account to cover the high deductible on the medical insurance. The monies that the employees put in the HSA bank account obviously have caps on it every year, but they can roll over from year to year to year and build up by the substantial savings, and that can be invested also in that account. So for a lot of employers, you're going to look at, is it worth my while putting in a high deductible medical plan option for the employees? Premium wise, is there enough savings so that we can open up the HSA bank accounts to align with that program? one of the things to remember is the HSA bank account can be funded by the employee or the employer or both. That's another decision. So that's a matter of looking at the figures, but definitely it can be a very worthwhile venture for employers and employees that don't want to be paying money for insurance they're not going to use,
Right. So what are the caps for 2024 for HSAs?
For 2024, right, there are limits on both the bank account associated with the HSA, how much money you can put in that, and then there are certain qualified limits that the actual medical insurance, the high deductible health plan has to meet. So first we'll talk about that bank account. How much money can be put in that on a year-to-year basis tax-free? So for 2024, how much you can put into that bank account depends on whether you're single or married and what age you are. So 2024, the limits were $4,150. That's for an individual. If you were a family, then that limit goes up to $8,300. That's quite a substantial amount. For those people over age 55, there's a catch-up that's allowed, and that's an extra $1,000 per year. For 2025, the limit is $4,300 an individual, $8,550 for a family, and the same catch-up of $1,000 for those that are over 55. So I mentioned earlier that there are two sides and two sets of limits when you're talking HSA. So we just covered the bank account limits and how much somebody can put into their health savings bank account. Let's take a look now at what qualifies as a high deductible HSA compatible medical plan. So for 2024, the minimum deductible on that plan was $1,600. 2025, it goes up to $1,650 for self-only coverage. For the family, the minimum deductible for 2024 is $32,000, and that raises to $3,300 for 2025. There is also limits on the high deductible medical plan that's HSA compatible on the maximum that your employees can have out of pocket. 2024, that's $8,050 for an individual coverage, $16,100 for family. 2025, it's $8,300 for an individual, $16,600 again for family. It stays the same. When we're talking out-of-pocket expenses, they always run on a calendar basis, January to December. That means that the employees' co-pays, their co-insurance, which is usually on PPO, on hospital surgery, complex imaging, specialty drugs, they're high out-of-pocket limits. So that there's a limit of, as I said, for 2025, $8,300 and $16,600 that the employees can have, depending on single family, maximum out of pocket on those programs. One of the caveats for a high deductible health plan, and this is going back to, again, the Obamacare regulations, the Affordable Care Act, requires that all plans, whether high deductible or not, cover preventative care 100%. So when you have a high deductible health plan that qualifies with a HSA bank account, there are no expenses, with that one exception, your wellness benefit, your preventative care benefit, that are covered prior to meeting that deductible. So that's your prescriptions, your doctor visits, any kind of surgical benefits. They're all subject to the higher deductible on those plans, with the one exception. You can go and have your annual physical and annual OBGYN, and that is covered.
Okay, I'm just going to ask this question because people that aren't as familiar with this may not understand. We talked about, FSAs, we talked about Section 125, and then we talked about health savings account. Is there a relationship between a health savings account and a Section 125?
Yes, the premiums for your HSA can be written off the same way as the premiums towards any other qualified benefit plan. So for the employer, again, the same caveat is that the money you're writing off on your share of costs is tax deductible from your corporation. For the employee, the premium that they're paying towards their share of coverage on the medical high deductible health plan is completely written off against payroll taxes.
Okay, thank you very much for that clarification. Let's move on now. Actually, I'm going to go back to something we talked about earlier, and that's dependent care under a flexible spending account. So what are the write-offs for dependent care, and what are the caps for those?
So when we're talking about, again, going back to the payroll tax write-off versus the income tax write-off for dependent care, that's, again, remember that dependent care is not simply child care. It can also be the care of an elderly or invalid dependent that's above age 13, as long as they're a dependent on your income tax return. So we always expand that definition because a lot of people just think childcare. It's a little bit more than that. So the tax write-off, remember, is different on payroll versus your income tax returns. When you're doing a tax write-off on your income tax return or your dependent care expenses, the amount that you can write off depends on your tax filing status. So if you're a single person, it's a $2,500 tax write-off. If you're filing jointly, it's a $5,000 tax write-off. Through payroll, it's a $5,000 regardless. Number two, when you're filing your income taxes, remember, your write-off then is based on your adjustable gross income, which is your taxable income. And you get a credit on that. Most people are only getting 20% of that expense. Through payroll, if you're in a high tax bracket, we live in California, so we are, you're usually getting a 30% or more. So you want to look at both ways, which way is going to work out better for you.
Right. And what are the types of plans that are considered qualified plans under Code Section 125?
Again, going back to the premium conversion or the POP, most plans that reimburse a direct medical expense are tax-free, right? So that's your medical, your dental, your vision. Some ancillary benefit plans can also be tax-free. A cancer plan, we see Aflac, Colonial, American Heritage, American Fidelity, all selling these extra voluntary ancillary plans to employees. And they do have merit. A critical illness plan, they're plans that will, where employees can insure against heart attack, stroke, and some other critical illnesses. Hospital indemnity plans, employees can have those if you have high deductible or high co-insurance on hospital stays. And they would be probably the three most popular. An accident plan, we have a lot of auto dealer clients, and the techs like to have those because they're injury prone. The plans that don't qualify would be life insurance that's above 50,000. While disability income protection does qualify to be pre-taxed, we do not advise it because it is not reimbursing a direct medical expense. It is reimbursing you for lost income. So if you pre-tax your premium, then the benefit is going to become taxable. I would much rather the benefit be tax-free. Again, that's a choice for the employer and the employees, but we usually advise that you don't pre-tax your premium on the disability program, short or long term.
Right. We do the same. We make the same recommendation. In your article, you said that people should take into consideration the uninsured penalty on California tax returns versus filing your state return if you don't have health coverage or if you were not eligible for an exemption from coverage. Can you explain what all this means?
We could do a whole podcast on just this subject. It's quite complex.
Let's do the bullet point short version for our audience.
So generally, low income families can qualify for exemption. We're going to talk about the exemption that's to do with income, right? Mm-hmm. There are other exemptions such as church affiliations. You're with an Indian tribe. They're more unusual. But for the majority of employees, if you were looking to qualify for an exemption against the California mandated uninsured penalty, they'd be looking at your income. The rule for 2024 and 2025 is the same for families where the cost of the lowest cost plan available to them, whether it's on the individual market or through the employer, exceeds 8.39% of their family income. They then can apply when they do their tax filing to the Franchise Tax Board to get an exemption. The forms are complex on that. We won't go into details today, but basically you want to always know what your income is, what the cost of the lowest cost plan is, and does it look like your income is going to be under the threshold where the 8.39% would be unaffordable. The second thing that will get you off the hook is if your income is so low that it's below the tax filing threshold. That's simple. So it's either your income is below the tax filing threshold or your income is so low that the lowest cost plan available to your family would exceed 8.39% of your income.
Well, thank you very much. Let's talk about when there is no penalty. Is there such a thing?
Not in California, there's not. There's a penalty when you file your state taxes, when you cannot prove that you have had insurance. There are some slight exemptions. So if somebody loses their job or loses coverage, you can go uninsured for a maximum of up to 90 days. Now, don't think that that's 3 months, because some months have 31 days without incurring the penalty. So when you file your franchise taxes, the months then, if you show that you went 60 days or up to 90 days without exceeding that, without insurance, they won't penalize you. The penalty on your tax returns is calculated on a month-by-month basis for every month that you were uninsured that exceeded that 90 days.
Well, I do want to mention that we do have, obviously, audience members who are outside of California. So in those situations, they want to check their state requirements, right? And their state.
Exactly, because when President Trump was in office, I believe it was him that eliminated the federal mandate to carry insurance or pay a fine. Mm-hmm. However, some states then brought that back in. The governor of California was one, and they brought that in. The advantage, however, for a lot of us is because this is a California state mandate, the tax filing threshold for your California state tax returns is a lot higher than your federal state tax returns. So when you're looking at that, it's a little bit of an advantage.
Right. But just as we mentioned, if you're in a different state, California rules might not apply to you, but you need to check to see what exactly you can and can't do in your own states and what the limits are and so forth and how that
works. And check obviously your state tax filing threshold. So in California, a single filer will file taxes when their earnings are above $19,310 for 2024 and $19,970 for 2025. Married, it's $38,620 filing threshold for 2024, and that increases then to $39,940 for 2025. There's another caveat for those of us who are a little bit older. The single filing threshold increases when you're 65 or older. $25,210 for California 2024 and $25,970 for California 2025.
Okay, thank you. So we talked about cafeteria plans. Let's talk now about tax write-offs on tax returns without a cafeteria plan. Can you explain what they can and can't write off?
Yeah. Well, one of the biggest tax write-offs on anyone's income tax returns is mortgage interest, right? And now that interest is even higher, so you get an even bigger tax write-off. So it's always a great investment, I say, to employees to have a home, pay a mortgage, and be able to get that tax write-off. As you all know, you need, depending on your circumstances, most mortgage companies require 10% down payment. Some will go lower for first-time buyers or low-income people, but generally it's a 10% or 20% rule. And then you're paying now, I think, average 5-6% on new mortgages. That's a heck of a lot of interest that you can write off against your taxes and lower your tax bracket as well as the amount of taxes you owe. The nice thing about a home for long-term investment is that while you're putting 10% down, you're making money on the principal as that house goes up in value. And we know where homes have gone in California over the last 10 to 20 years. People that bought $1 million home back in 2012, that's worth $2 to $3 million now in a high return area. So it's a great investment to do that. While we're speaking of tax write-offs, most employers now are mandated to put in a 401k or a savings plan for their employees. Mm-hmm. And one of the advantages of that for an employee is that allows you to save money very quickly, tax-free. And what most employees don't know, and it's of extreme value to the younger employees, is that if you're buying a home, you can take up to 50% of your 401k monies out as a loan. You never take that as a distribution. That has penalties and taxes. But you can borrow up to 50% of your 401k savings, up to $50,000 a year as a loan, and you're paying that back to yourself. Furthermore, that loan does, if you're using it to buy a house or put a down payment on a home, it doesn't affect your credit score or your debt to income ratio, which are two things that a mortgage lender will be looking at. So it's a fantastic way to save, for your employees to save, and for employers to help put those younger employees and their families into their first home, which we know overall will benefit you. And your quickest way to wealth accumulation is owning a property.
Okay. Are there any specific health items that you can write off on your tax returns individually?
Yeah, as an individual sole proprietor, they get to write off all of their health expenses completely against their taxes. But for the rest of us, you're doing an itemized tax return, and that means a lot more work. You're having to add up all your premiums that you paid and all your out-of-pocket expenses. The problem with taking those on your income tax returns as a tax write-off versus on your payroll is that the IRS will only allow you a tax credit on those amounts that exceed 7.5% of your adjusted gross income, which is really your taxable income. Most people, their adjusted gross is so high that 7.5% of that is another high amount, and they're not really getting a substantial tax write-off. But we'll go low and we'll say that your taxable income, your adjusted gross is 50,000. 7.5% of 50,000 would be 3,750. So for those that are not writing off premiums, they're writing off out-of-pocket medical expenses. None of us have those expenses. You know, very few people will have expenses in excess of that 3,750.
Right. And hopefully if they do, they have health insurance and they have their card, and that's covering all of it. So let's talk about qualified insurance plan contributions. Those can be written off on your taxes. Can you tell us about the above line deductions and the itemized deductions that you were just referring to?
Okay, so when you're looking at income tax returns, the very first thing you're looking at is your adjustable gross income or your taxable income. And that's usually calculated on your 1040. So that includes all of your income from all sources. So you're calculating wages, salaries, interests that you made, dividends. If you have rental income, that's supposed to be reported. Any kind of capital gains, if you sold property or stocks during the year, they're going to calculate your gains and losses. Any kind of business income, if you had a side business, and that's all going to go into the income part. Then on your income tax return, they're going to make adjustments then to that, and they're going to subtract out specific adjustments from your gross income to arrive at what's called AGI, adjusted gross. That's usually referred to as taxable income in plain layman's terms. So they're going to look at if you made any contributions to an IRA or a 1K, that's going to come off. Student loan interest is also another deduction. Tuition and fees, college tuition. Health savings account contributions, we discussed them earlier on, but if you have that and you're doing it on your income tax, that comes off the top. And then if you're self-employed, your business expenses would again come off that. So that all then calculates your taxable income.
Well, thank you for that explanation. A lot of us, like me, don't really enjoy these types of things. So this kind of detail is actually something that we need, even though we may not want to pay attention to it. It's something that we need to. So both cafeteria plans and income tax return write-offs offer savings, but they're basically operating completely differently. Can you explain the timing and the application and how this works?
The main difference between taking a tax write-off, if you can, obviously, through payroll versus claiming that same tax write-off on your income tax return is that payroll gives you a tax break on all payroll taxes, usually 30%, on first dollar and every dollar, versus trying to do that on your income taxes and only getting the write-off on the amount that exceeds 7.5% of adjusted gross income or taxable income. For the majority of people, the benefits that you can write off and take a tax break through payroll are going to be always better through payroll. What you can do then on your income taxes is take the tax write-offs there that obviously you can't get through payroll. Very few that you can get through payroll will actually be better on your income taxes. So that would be things like, as we said, your mortgage interest payment, which is a huge one. Charitable donations, that's often overlooked. Your employees need to understand that any money they give to church or a charity throughout the year, or if they donate home goods to the likes of Goodwill or the Samaritans, they can write that off if they keep the receipts against their income taxes. So at the end of the year, if that employee has $3,000 that they owe on taxes, if they had enough charitable donations, they would be able to eliminate or definitely reduce that tax obligation. So it's important to know that.
And what about the eligibility for a cafeteria plan in general?
When we're looking at a cafeteria plan, the premium conversion eligibility requirements, everybody is eligible to participate in that plan. What you want to be more careful of is discrimination rules. And there are discrimination rules on the amount that can be written off by owners and key employees versus the amount that can be written off by your regular rank and file employees. And the general rule of thumb is that the owners and key employees, once you understand who they are, owners include 2% or more owners. Key employee, I think, is defined now at around 153,000 a year or above. Those earners, you look at everything they're writing off on their premium tax write-off, and it cannot exceed more than 25% of the total write-off. So what I used to do when I worked for the TPA over 11 states is we'd calculate what the employees were writing off, assume that's 75% of your total write-off, and divide by 3, and that's the limit that the key employees and owners have. Hope that makes sense. Now, when you're looking at the flexible spending accounts, the rule is different. I think they can't have more than 55% of the total write-off. So you want to, again, be sure that that's not only being used by your key employees and your owners.
One thing that I do want to bring up, though, and that is if you are an S corporation. I know our company is an S corporation. We do not qualify for a Section 125 plan, the owners at least.
Yeah, that's a good point, Dorothy. But as an S Corp, again, you do get to write off all your own personal medical expenses. against your taxes anyway, right?
Right.
Because if we have an S Corp and we currently pay, for the owners 100% of everything, including the wellness benefit program. And we did have, which we didn't bring up today, a tuition reimbursement program, which can also be useful. But again, there are rules on who can participate in that, and it cannot be weighted towards owners or employees of owners. So it has to be a fair program. And then there's limits on how much, again, owners and key employees can have on those programs. Can we also talk a little bit about the requirement now to have a 401k or a savings plan for employees that was mandated?
Are you talking about Cal Savers and that's California only? Yeah, you can
California only. And I saw that recently in an article that you had published on the celebration of the ERISA's 50th year anniversary.
Yes, you're right, Anne. I did bring that up in the article. I'm going to let you talk about this stuff, though, because you're the expert on the tax-related stuff. My article was well-researched and had an ERISA attorney, of course, assist me with that. But from a tax perspective, as you know, that is not my thing at all. So, yes, here in California, we do have that requirement for a savings plan. And if you don't have one as an employer, you can sign up with Cal Savers, and then your employees will have tax-preferred contributions into that savings plan. So that is something we do here in California. Again, because we have audience members all throughout the country and even outside of the country, that does not apply in all states or all countries.
One of the things I wanted to bring up about that is we've seen a lot of small employers for the first time having to implement, 401k plans, or as you said, the Cal Savers savings plan. And there are limits on the discrimination testing on what the owners and the key employees can contribute on those plans. And one particular one I want people to listen to, particularly if you're a small employer, and we saw a small employer get hurt badly by this, was the agent that implemented the 401k did not explain the top-heavy testing and the discrimination testing to the employer. And he had a very low-income employee group. In fact, it was maintenance for buildings. They did building maintenance. And before the first year of that plan was out, he had only put in $5,000 himself into the 401k. His low-income employees didn't put in money. That disqualified him from meeting the top-heavy testing. So he had more than, I think it's 55% of the total money that was put into the 401k. And that then forced him by law to have to put in 3% of his payroll for every employee that was eligible to participate, whether they did or not, that first year. And then everyone that was eligible to participate for the second year. It was a 2-year problem that cost him $50,000 in 401k matching contributions because it hadn't been explained to him that there were limits and he needed not to put money into that plan without verifying that he wasn't going to go over the top heavy or the discrimination test at the end of the year.
I'm glad you brought that example up because it's something that we always say at the end of our podcast in our standardized closing, right? But one of the things that I want to mention right now is that we're not attorneys. Anne is not a CPA in this country. She is not an attorney. We're not attorneys. We're not giving you any tax or legal advice. We're giving you general information, right? And we always suggest that, take a listen to what Anne has to say. She's always very knowledgeable on this stuff, but take it with a grain of salt and understand that you need to check your specific situation and run that by a tax professional and or an attorney if certain things apply, like if it's a complicated case, that sort of thing, especially, right, Anne? So I just like to mention that.
And by all means, you can reach out to myself or Dorothy with those questions, or if your CPA doesn't know an answer or you get a weird answer, we can obviously talk to the CPA, because believe it or not, there are a lot of CPAs out there that don't understand the ACA, Affordable Care Act. They don't understand how that works.
That's scary.
It's scary, but they're there. I just had an employer call their CPA last week, and he said, I don't have enough information on that. It's not my focus. So we do, I would say we're pretty much experts on it, but we're not CPAs. So our E&O insurance, which is errors and omissions, will not cover us for giving you tax advice. So we'll give you to the best of our knowledge, and then we ask you to verify that with your CPA. If your CPA doesn't understand those plans, well, then you're going on our advice, but our coverage doesn't cover you.
Exactly. Well, let's talk about the types of savings and all of these types of things. What are some of the savings that employers and employees can find if they use these types of tax incentives, shall we say?
The savings can be absolutely fantastic. And right now, as I said, the Section 125 Cafeteria Plan, those benefit tax write-offs, whether it's your premium conversion or whether it's the flexible spending accounts. There's other things that can be in a cafeteria plan too, like commuter benefits, but we didn't go into those today. We're keeping it to the basics and simplified. The tax write-off, as I said, for both the employer is fantastic. You're getting a tax write-off against your corporate taxes. Every dollar that the employees are spending, whether it be on their premium, particularly the daycare write-off, because we know that that's expensive in California, you're not matching your FICA tax. And FICA tax is 7.65% payroll. It's made up of Medicare, 6.2%, and OASDI, Old Age Social Security, that's your pension, and disability income, 1.45%. So that's a huge tax write-off. For those of you that have a high workers' comp mod, pay attention, because the more benefits that are reducing your gross taxable payroll, it's also having a same domino effect on your workers' comp costs. So that can all be very valid. For most employees, they don't really get a tax write-off on their income tax returns. Again, it's because it's only going to be those amounts that exceed the 7.5% of adjusted gross taxable income. Most people don't have enough expenses to get there. If you do, that's brilliant. But for the majority of employees, they don't. For those of you who are small group and you don't have to comply with Affordable Care Act, the mandatory employer minimum value plan that is affordable. Again, affordability is that the employee's share of coverage for the lowest cost plan doesn't exceed 8.39% of their income. For 2024, is that right, Dorothy? And it goes up to 9.12 2025.
I believe so, but I don't have it memorized.
Yeah, I have the figures, but I think that's close.
Sounds familiar. That's all I can say. Sounds familiar.
For the large employers, and this is a commonly misconstrued thing, large employers have to offer the minimum affordable plan. Again, the lowest cost plan employees share, not your contribution, their contribution of coverage cannot exceed 8.39% of their income. There are 3 affordable safe harbor tests that the IRS and the Franchise Tax Board use. One is W-2 box 1 income for your salaried employees, that the cost of coverage doesn't exceed 8.39% of that. The second one is hourly rate of pay. Not any hourly rate of pay, the hourly rate of pay for the tax year in question at the earliest point in the tax year that that employee was actively employed and eligible to go on the benefit plan. So if somebody was there January 1, you're going to use hourly rate of pay January 1. If they were employed June, you'll use their June hourly rate of pay. It's always per the IRS formula going to multiply by 130 hours times 8.39%. So it doesn't matter if they're working 40 hours a week. The formula, again, that the tax man will use to make sure you're offering an affordable plan is hourly times 130 times 8.39. The third measure is federal poverty level. Very few people do that, but that gives you what's called a qualified offer and limited reporting. So large employers with 50 or more full-time eligible employees, that includes your part-time hours, another formula divided by 120, not 30 hours per month, gives you the full-time equivalent. So on a month by month, you check that. If you go over 50 employees, then the following year, you're required and mandated by law to offer your employees a minimum benefit that meets that affordability measure. What's commonly misconstrued is by offering your employees an affordable plan, that disqualifies the employee, not their dependents, from getting a tax credit through the exchange, which is covered California in California. And for all large employers, you generally will give your employee a mandatory marketplace notice telling them that you are offering them an affordable plan, what the minimum cost is, and that it disqualifies them from getting a tax credit through the marketplace covered Cal. The piece that's misconstrued is if you work for a small employer that's under 50 employees, and that employer offers you a plan that is affordable, that disqualifies you again. So people don't understand that. So if you have work for a small employer and the lowest cost plan they offer you meets minimum value and meets the 8.39% affordable, you are not eligible to take a tax credit through covered California. The tax credits are based on income, and for most people anyway, you're not getting much. You're paying anything from 4 to 8%. Towards a silver, the second lowest cost silver plan. We live in California. You don't qualify for the majority. Minimum wage keeps going up. You're way better off anyway taking the 30% tax break through payroll.
Okay. Well, the question that I often get asked, can you do both?
You can. Your dependents, Dorothy. So it's very smart if an employee has an offer through payroll that they take that offer if it meets the affordability and take the tax write-off. Their family members can still qualify for the tax credit through the exchange. So they always want to be looking at what plan and tax credit would the rest of my family get via the exchange versus me paying their cost of coverage through payroll and taking the payroll tax break. That has to be looked at on a case-by-case basis. Again, for high income earners, if you're not getting a tax break on the exchange, always take that tax break through payroll. And again, we're living in California. Most of us have a very expensive cost of living here, so the wages are in line with that. Right. Unless you're very, very low income, really between 138 and 250% of federal poverty level, which is based on family size and income. It's only people within that income range that want to be looking at covered Cal tax credit versus what they're going to get on payroll. Most of us are over 300% federal poverty. It's going to be payroll tax break all the way, at least until the government figures that out and they eliminate it. It's been around since 1978, but I'm concerned. But while it's there, we'll take it.
Yeah, you never know. Well, thanks so much for all this wonderful, valuable information. As I said, I don't like anything tax related, so I'm glad I've got experts like you that I can go to and say, explain this to our audience. If someone would like to reach out to you, how would they do that?
Absolutely. I'd be delighted to answer anybody's questions through Advanced Benefit Consulting. We're all part of that same co-op, so we all help each other out and do training. Tax happens to be my expertise. So my email address is long, but it's my first name, Anne, ANNE, at kellyandkellyinsurance.com, KELLYAND, KELLY. So it's ann@kellyandkellyinsurance.com. More than happy to look at anything for you if you're interested. And I will say, if you're an extremely large employer, that's usually Dorothy's area on the benefits, because she does all the self-funding. That's her expertise. So hopefully we've helped everybody today and you've learned something. Please feel free to email with your questions.
Well, thanks again. I really, really appreciate you being here today. To everybody else out there, please stay safe, stay healthy, and stay tuned for the next episode of the Benefits Executive Roundtable. Thanks, everyone.
Thanks for watching. Stay tuned for compliance tips, cost containment ideas, new trends, and decision-making tools. This podcast is produced by Advanced Benefit Consulting, Anaheim, California. All views expressed are those of the host or interviewees and not necessarily the views of Advanced Benefit Consulting. Information contained herein should not be construed as legal advice. We always recommend that you consult with your legal counsel as situations do vary. Ms. Cociu can be reached at 714-693-9754 extension 3 or toll free at 866-658-3835. By email at dmcociu@advancedbenefitconsulting.com or visit our website at advancedbenefitconsulting.com.